What is Forex? Offshore foreign exchange trading is open 24 hours a day, 5 days a week, starting at 5 p.m. Eastern Time on Sunday, all the way till 5 p.m. Eastern Standard Time on Friday. Businesses, banks, investors, and retail traders all trade through online brokers. All the currencies are grouped in pairs. For example, we have USD versus Japanese yen, Euro versus US dollar, Great British Pound versus US dollar. These are some of many currency pairs. Forex is the largest and most liquid market in the world. The average daily turnover is over $5 trillion. London, New York, Frankfurt, Zurich, Hong Kong, Singapore, Paris, and Sydney are the main Forex trading hubs of the world. The currency pairs traded in Forex are all quoted by the major banks, then the prices are quoted to the traders through brokers. When you place a trade, your broker is taking the other end. That means if you buy Euro USD, then your broker takes a sell. Vice versa. If you were to take a sell order, your broker would take a buy. Forex has more liquidity in one day than Wall Street has in a month. Leverage allows you to trade up to 50 to 500 times your actual account size depending on your broker, but beware, leverage can also work against you. The Forex market was fully established in 1971, and there are more than 100 currencies in the world. The most common currencies include the US dollar, the Japanese yen, the euro, the British pound, the Swiss franc, and the Canadian dollar. Large banks such as Barclays, Dutch, HSBC, and JP Morgan make up for roughly 50% of all Forex transactions on a daily basis. Hedge funds, portfolio managers, and pooled funds are the next big players in the game. That's Forex. Central banks also play a crucial role as they're responsible for Forex fixing. The overall volume of retail traders is extremely low compared to the big players in the market. Fast movements allow for fast profits for both long and short traders. Remember, while there can be great reward, trading also comes with a great risk. Under no circumstance should any trader trade with money they can't afford to lose. Some sessions are more liquid than others, and certain times of the day that we trade. So for example, London and New York are two sessions that are much more volatile than Asia. Okay? But it also depends on the type of currency that you're trading. If you're trading the Australian dollar and the New Zealand dollar, chances are that it'll be a bit more volatile during the Asian session, whereas the pound, the euro are all more volatile in the London session. It all depends on the currency. Lastly, Forex is a business and must be treated as such, it's a marathon, not a sprint to the riches. Currency pairs are listed with 5 decimal point numerical value. A pip is based on the last number. For example, if USD CAD moves from 131.055 to 131.064, this is a 0.9 pip move. For yen pairs, the decimal point is to the third number. So, if Great British Pound versus Japanese yen moves from 140 to 140.009, this is also a 0.9 pip move. We make money in Forex trading by earning pips in the right direction. We lose money by trading pips in the wrong direction. For example, if we picked a 10.0 per pip lot size, then a move from 140 to 141 on GJ would net us $1,000 in winnings / losses depending on the direction we choose. So if we bought at 140 and price moved to 141, okay, then we would make $1,000. Why? Because we're making, pardon me, because we were making 100 pips, in the direction, which would net us $1,000. If we were to short at 140 and price went up to 141, that means we'd be $1,000 in drawdown. Okay. There's technical analysis and fundamental analysis. When we combine both together, we get a powerful combination. Fundamentals are based on economic data and political situations in the world, whereas technical analysis is based on support resistance, chart patterns, candlesticks, trend lines, etc. While technicals are more predictable in the Forex market, firm fundamentals on a country's economy should not be ignored, as this is what the big players are using when judging whether to buy or short. If you think you can jump into this market and start making money right away, you should take a few steps back and follow these steps. Okay? Make a trading plan consisting of the pairs you want to trade, the strategies you're going to use, the amount you're going to risk, the activities you're going to do outside your trading goals at the end of each month. Okay? Let's go over each one of those in detail. Okay? So the pairs you want to trade. Which pairs do you want to trade? This largely depends on the time zone you're in. Okay? Because if you're on Eastern Standard Time, you may find it tough to get up to the London session because this is in the middle of the night. okay? So maybe you want to focus on pairs such as USD CAD or USD JPY, okay? So which pairs do you want to trade? Which pairs have you studied? Which pairs do you think you will be able to trade? So this is all important. Don't try to trade every pair, okay, because there's a lot of pairs. Pick a few, maybe 3 or 4, okay, and focus on them and trade them as you will, okay? The strategies you're going to use. This is super important because different strategies work on different currency pairs, okay? This is why before jumping into the market, you have to backtest strategies, okay? You have to backtest how price reacts to certain levels, how price reacts when you see certain patterns, okay? What happens when trend line breaks? What happens when we get to a certain Fibonacci retracement level, okay? Every pair is different and every strategy is different. That's why it's uber important to backtest the strategy and see what the odds are, okay? Because once you have the odds of a strategy, then you can base that based on if you want to use that strategy or not, okay? Once you have a strategy with good odds, then it all comes down to risk management, okay? So make sure to formulate a strategy, okay? Make sure it works. Make sure you backtested it correctly, okay? Don't look for all reasons to always be right. It's okay to be wrong. You're backtesting. You're not losing any money, okay? Just, you have the advantage of backtesting and seeing what actually works, okay? So make sure to do that, okay? The amount you're going to risk, so how much money you're going to risk, okay? How much money you're going to put into your account? How much money you're going to risk per trade? Can you afford to lose this money, okay? Do you need this money for expenses other than trading, okay? If you have rent to pay, if you have a car to pay, if you have groceries to buy, okay? Make sure not to use that money for trading, okay? Always risk money you can afford to lose, okay? Trading is like an investment, okay? The activities you're going to do outside of your trading. What activities you're going to do outside of trading, okay? You cannot always be in front of your charts. This will be detrimental. It's been proven time and time again that people who spend more time in front of the charts actually don't do as good as people who spend less time in front of the charts. Do your analysis. See what levels are important. What is going to be the green signal for you to buy or short, okay? And yeah, other than that, unless you see anything else, if you see anything else other than that green light for you to buy or short, then you shouldn't be trading, okay? Because that's going to be your green light. That's what's going to make you engage into a trade. So make sure you have plenty of activities outside of trading, okay? Read it, whether it be reading, working out, eating healthy, watching movies, playing sports, playing video games, whatever you may be, okay? Make sure you have plenty of activities to get your mind off trading, because once your analysis is done, then you just have to wait for your green light to trade, okay? Your trading goals at the end of each month, how much do you want to make at the end of each month? Do you want to make 5%, 10%? If you compound 5% over 12 months a year, that's quite a bit of money at the end of the year. So make sure to have precise trading goals set at the end of the month, okay? How many pips is going to equal this percent of my account, and then go for the pips. Focus on the pips, because at the end of the day, we are looking for trades that will net us pips. The pips net us the money. So already if we're looking for the pips, the money's going to come, okay? So make sure to have a precise trading plan where you say, how many pips is going to equal this amount of percentage of my account at the end of each month, and just go for that number of pips. When building a forex strategy, it takes hours of backtesting to realize what works and what doesn't. Take some time on the weekends to study the charts and study how price reacts to certain levels, patterns, trend lines. So again, this is going back to building your strategy, okay? You're going to focus, when you backtest, make sure to backtest in detail. Take your time with backtesting, okay? What most people don't realize is the history always repeats itself in trading. At the end of the day, we're just looking for patterns to buy or sell, okay? It always repeats itself. You just have to look for the patterns in the charts, okay? Take your time with backtesting. Once you see the patterns, once you see the levels, once you see the trend lines, you'll realize how much easier trading will be for you, okay? I would not suggest using any technical indicators other than moving averages, okay? Why do I say this? Because technical indicators are usually lagging indicators, which means that they only react to price. So price has to make a move before the lagging indicator can make its move, you understand? And you'll see you're going to save so much time by not putting any technical indicators on your charts, whether it be a stochastic, whether it be RSI, whether it be the alligator. Regardless, they're all the same. They all don't work, okay? The big guys don't use indicators in Social View. Focus on price, see how price reacts, the candlesticks, support and resistance, and patterns. this tells you enough already, okay? Fibonacci retracements, all that. This tells you enough. You don't need lagging indicators, okay, guys? This is the end of this presentation. Thank you for listening, and I'll talk to you in the next presentation. Thank you.